the market's up, Chuck. And today's post was kind of a happy ending. As I mentioned in the blog, I watched an interview with Warren Buffett, and he was talking about, the interviewer was trying to pin him down as when the economy was going to end. And, of course, he pointed out, like I want to point out, things are very rough right now, but on the other hand, things are improving. But I think most importantly, as Warren Buffett said, in his interview, it's ultimately going to have a happy ending. And I think the key point I want to make here is that one of the advantages that all this trials and tribulations have brought to us is very, very low stock values for, the first time in a long time. In fact, the market's reaction, even though the recession was severe, was actually worse than it should have been. So, there are cases where, however, the reaction was, relevant. But the point I want to make is when values get low and stock and great companies have operating issues in the short run, once they stabilize and earnings come back to normal, you can have some powerful upswings in stock prices. Today Goldman Sachs is going to be reporting, and there's talk about them, throwing off a couple of $1 billion in profit after they've already paid back TARP. And I chose that because one of the articles I read pointed out that Goldman Sachs' stock price is already up, something like 68%. This year. And the point is, when the price fell, in the case of Goldman Sachs, it really did fall because earnings fell. But I do want you to notice that at these, very low valuations here, the company's still only trading at 14 times earnings even today. It has recovered from a low of around $84 a share up to $141 and change yesterday. I think it's up about 4 or 5% today. So, when stocks get cheap, there can be some very quick and some powerful, upswings. From the beginning of the year, we're talking in 6 months, the stock is up, almost 70%. The next example is Weatherford International, which is an oil services company, and the price of oil had dropped. Remember how everyone was being scared to death that oil was, going to go up to $200 or $300 or $400 a barrel, and the price of gasoline was going to go to $4, $5, $6 a gallon. And today we've got rather benign gasoline prices again, but I do want you to notice something. The price of, or the earnings potential of Weatherford did have a big drop in its earnings. However, it was, a massive overreaction by the market. The stock fell from, frankly, being overvalued, which the market was being, irrational in that regard. It got all the way down to about $7 a share here at the bottom, and now it's back up to 18. Well, this has been a powerful recovery just in a very short period of time. So, where people are running from stocks right now are really making a big mistake, in my opinion. They should be looking at how cheap stocks are and be looking at, how much money they can make both in the short and long run, because when stocks are cheap is the best time to be buying them, obviously. And my final example here is Cerner, which is a company that basically is involved in medical information, which is a big buzzword going on in in the world right now. But I want you to notice that when the recession first hit in 2008, Cerner fell just like all other stocks did. It fell from around $46 a share and then got down all the way to 33. But look how quick the recovery has been since. If you look at January of 2009, the stock was trading at 33 3/4. And yesterday it was, or at Friday's close, it was 57.61. Look how powerful that upswing is. And the reality of it is, stock prices are always going to be wiggly lines like this. They're always going to be volatile. And they're also always going to be unpredictable. People are always looking for patterns in stock price. I find that foolish. The reality of it is the company's earnings growth has been very, very strong. And when you look at the long-term return that shareholders of Cerner made, they equated very closely to the operating results of the company, as I point out over and over again. And the market and the general market and the economy had very little to do with that. But the point I want to make is this company may be actually certainly pricey, if not overpriced today, because it has had such a quick run-up. But I just did want you to basically at least see and consider the fact that when stock prices get real cheap, like like Cerner was back, just a few months ago, the rallies can be very, very strong. Ultimately, it's these operating results that matter the most, as I've said. This is Chuck Cramer. I hope this gave you some additional insights, and I look forward to talking to you again tomorrow.